Every day, thousands of people buy penny stocks after watching a short video that says, "Buy this now before it takes off." Most of those people are not reckless. They're not greedy. They're simply new. Penny stocks feel approachable. A stock trading at $1 or $2 feels affordable. It feels safer than buying something expensive. And psychologically, it feels like there's more upside than downside. If it goes from $1 to $2, I double my money. That logic feels reasonable, but it's incomplete. The price of a stock tells you almost nothing about the quality of the business behind it. A low price does not mean a good deal. In many cases, it reflects higher risk. Most penny stock companies are small businesses operating under pressure. They often have little or no profit, inconsistent revenue, and limited access to capital. These companies are not bad by default, but they are fragile. That fragility matters more than most investors realize. When a large company needs money, it can rely on profits or borrow at low cost. Penny stock companies usually don't have those options. They need cash just to keep operating. Instead of understanding how these businesses survive, many investors focus on the story: a new product, a future breakthrough, a big market opportunity. Social media amplifies these narratives, often without context or investigation. What's rarely discussed is how the company pays its bills while waiting for that future. Ignoring that question is where most losses begin. Penny stocks rarely destroy investors overnight. They wear people down slowly, while hope stays alive. The most common reason penny stocks destroy new investors is share dilution. It sounds complex, but the idea is simple. When a company needs money and can't generate it through profits, it often raises cash by issuing new shares. Those shares are sold to investors or into the market. The company gets money, but your ownership shrinks. Nothing illegal happens. Nothing dramatic happens. But each share now represents a smaller piece of the business. Here's an easy way to think about it. Imagine a pizza cut into 8 slices. You own 1 slice. Now the company needs more money, so the same pizza is cut into 16 slices. You still own 1 slice, but it's smaller. That's dilution. In penny stocks, this happens frequently, sometimes every year, sometimes multiple times a year. Over time, the total number of shares grows, and the value of each share struggles to hold up. This is why many penny stocks look cheap but never recover. Even if the company continues operating, the share count keeps increasing, and as shares increase, upward price movement becomes harder. New investors often miss this because they focus on price instead of structure. A $1 stock feels safer than a $10 stock, but dilution doesn't care about price. A stock can fall from $1 to 50 cents, then to 20 cents, even if the business survives. And understanding dilution doesn't make you pessimistic, it makes you informed. Psychology plays a huge role in penny stock losses. A low-priced stock feels forgiving. Losing a few cents doesn't feel serious at first. It feels manageable. That's why many investors hold penny stocks far longer than they should. Hope keeps people invested. Hope that the next announcement will change everything. Hope that earnings will improve. Hope that someone else will notice the stock and push it higher. Online content reinforces this hope. Many videos and posts focus on upside without explaining risk. Often, this content is created for views, not education. That doesn't mean everyone has bad intentions, but incentives matter. Exciting stories spread faster than boring risk explanations, and new investors often follow confidence instead of evidence. There's also survivorship bias. People hear about the few winners and never hear about the many quiet losses. Gains are shared publicly, losses are kept private. Over time, this creates a distorted view of reality. Another trap is averaging down. Investors assume lower prices mean better value without understanding why the price fell in the first place. Without analyzing dilution, debt, and cash flow, lower prices often mean higher risk. Most losses don't come from one big mistake. They come from repeated small decisions made without full information. It's important to be clear. Not all penny stocks are bad. There are legitimate small companies trading at low prices. Some have real businesses, responsible management, and improving fundamentals. Some investors do make money in this space, but those cases are the exception, not the rule. The real problem is buying penny stocks without understanding risk. Many investors rely on recommendations instead of research. They follow confident opinions instead of asking basic questions. Good penny stock analysis starts with fundamentals. How does the company fund itself? Is revenue consistent or volatile? Is the share count increasing every year? Is management aligned with shareholders? If these questions don't have clear answers, price becomes irrelevant. A cheap stock without clarity isn't opportunity. It's uncertainty. Education changes how you view these stocks. 5. Instead of asking how high a stock can go, you start asking what could go wrong. That mindset alone protects capital. This approach isn't about fear, it's about responsibility. Long-term investing success is less about finding big winners and more about avoiding unnecessary losses. Penny stocks attract attention because they promise speed, but speed often hides risk. Understanding dilution, cash flow, and psychology doesn't guarantee profits, but it dramatically improves your odds of survival. And survival matters. You don't need to avoid penny stocks completely. You need to approach them with patience, skepticism, and discipline. If you don't understand how a company survives, you shouldn't risk your money on it. Markets reward calm decision-making more than excitement. That's why this channel focuses on risk before returns, because returns don't matter if you ignore what can go wrong. When you slow down, question stories, and focus on structure instead of hype, you put yourself in a stronger position than most retail investors. That's how capital is protected, one informed decision at a time.